Welcome to this briefing on economic indicators, where we'll unpack what key signals really tell us and why they matter for policy and business. Over the next slides, we'll connect raw data to practical decisions, highlight how to read momentum versus noise, and show how short, focused insights can help professionals act faster and more confidently. This diagram shows how raw economic activity becomes timely signals and then actionable choices. Indicators flow through a kind of filter that informs governments, firms, and households, prompting policy tweaks, production adjustments, or budget resets. The result is clearer allocation of resources and lower uncertainty, so you can see why timely data matters for smarter decisions across the economy. When GDP is rising, it signals expansion, more production, stronger consumption, and higher employment, and decision-makers respond accordingly. For example, by considering interest rate changes or pursuing corporate investment. Conversely, consecutive declines warn of recession and prompt firms and policymakers to tighten strategies and support demand. So GDP trends shape both macro policy and business forecasting in very practical ways. Unemployment rates reveal spare capacity in the labor market and point to different economic pressures. High unemployment signals underused resources and falling incomes that may require stimulus, while low unemployment tightens labor markets and can presage wage-driven inflation. Tracking these shifts helps policymakers and businesses decide when to boost demand or prepare for rising costs. Price indices like the CPI and PPI measure changing costs and the erosion of purchasing power, and inflation can play out two ways. Moderate inflation greases growth, while runaway prices destroy savings. Central banks watch these dynamics closely and may raise interest rates to rein in excessive inflation. So understanding the source and pace of price changes is critical for policy response. Leading indicators, like new orders or yield curve shifts, point to future economic turns and let firms act proactively, while lagging indicators, such as unemployment and lagged data, confirm what's already happened. Using both together moves strategy from reactive troubleshooting to forward-looking adjustments, enabling earlier action when signals suggest a coming shift in conditions. Decoding indicators means looking beyond single numbers by comparing trends across time, regions, and sectors, and by making critical adjustments for seasonality, revisions, or external shocks. That layered approach helps separate temporary blips from sustained momentum, giving analysts a clearer sense of genuine economic direction and a stronger foundation for informed strategy. Microlearning packages make absorbing indicator insights efficient. Short, focused modules boost completion and engagement while cutting training costs. And they fit into daily micro-moments, so professionals can update their perspectives quickly. The visual here highlights higher completion rates and cost savings, showing how concise lessons translate complex signals into usable knowledge. Short lessons also accelerate real-time application. Brief modules raise engagement and mastery speed, enabling analysts to feed GDP data, inflation metrics, and employment figures into instant analysis. That, in turn, supports rapid strategy adjustments, risk assessment, and identification of growth opportunities, making economic data actionable within business decision cycles. Turning indicators into strategy means three practical moves. Translate forecasts into tactics like pricing, hiring, and capital allocation. Set alert thresholds and run scenario analyses to prepare for different outcomes. And embed real-time dashboards so teams can act faster than competitors and convert macro signals into operational advantage.